Welcome, everyone, to the December monthly market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here, joined, as always, by Bob Paolucci, our founder and CEO. Bob?
Good morning.
This is our last event for the year. Are you excited?
This is our last event. Yeah, I'm excited for next month. It'll be the our outlook for 24.
Yes,
It sounds like we got 23 right. We sounded like lunatics in January of 23, but
for
everything
sure.
happened the way we thought. But yeah, the last one, and it'll be a light one.
Yeah, I think it'll be a light one. Let me share the agenda if I can really quickly. So the topic or the title, excuse me, is a November to remember. So we're going to kick this off by talking about how good of a month we just recently had in November. We're going to continue through to December, which typically is also a very good month in the markets. And we're going to talk about consumer spending, shop until you drop, and the record success that we had with Black Friday this year. We don't talk enough about dividends and buybacks, but we want to address the rise in dividend buybacks and why it's fuel for the market. We're going to have this awkward, if you see this awkward comment here, the strongest recession ever continues. We want to address whether or not we are in a recession. And then a couple of other things we're going to talk about is, I think, the simplicity of bond math. We're going to talk about yields being down, which means bond prices are higher. And finally, we're going to end on a sour note, unfortunately, and talk about the atrocity of our government spending and what we have seen recently, and maybe some of the implications going into next year, if that's fair.
Sounds wonderful.
So, all right. Well, yeah, let's kick it off with the fact that November was such a great month for 2023. It was, in fact, up about 8%. And what we're showing here are monthly returns of November going all the way back to 1930. And you can see there are very few times we have had a return of 8%. In fact, it's been fewer than 10 times going back to 1928. And I think, Bob, there's a reason we're being very nitpicky about this, if you want to address that.
Yeah, absolutely. So high single digit returns in a month usually come after bad months. Right. So good months come after bad months, good quarters come after bad quarters. You have to just be along for the ride. You have to have patience, and you have to have some meaningful time frame for proper measurement of your portfolio and for your underlying investments. And measuring in months and days is horrendous. It absolutely is the most emotional thing that you can do. It'll drive you nuts. It'll also send false signals when you have three really good months. Don't worry, the fourth month will come along and it'll be negative. So don't fall in love when things are great, month over month over month, and don't be so depressed if you have a couple of bad months. Returns come in bunches, and this is an illustration of it. The summer months this year weren't great. It was purely driven not by fundamentals, but by higher long-term rates, not the Fed controlling short-term rates. They did nothing.
Yeah.
It's higher long-term rates. And that was skewed by the government needing to restock their bank account by selling bonds. They sold a lot of bonds very quickly, and the spike up in bonds sent stocks down. And then it stopped. And when it stopped, it sent the market up quickly. So November is one of the best months we've had in years, and it was one of the best Novembers ever in history. So you really have to be along for the ride and understand that volatility is normal. Returns come in bunches, and I'd love to say we know exactly when and why they're going to come. There are so many reasons why this happens. You just have to have a good portfolio. You have to have patience. You have to measure over time. And if you do all those things, that's a very likely a very positive outcome over time. But
Yeah.
imagine, Julina, imagine not being invested in November because July, August, and September and October were
We're
horrendous.
so frustrating.
You missed out on the bulk of the year's return
Yeah.
in one month. If you went on vacation for 30 days, you missed it.
Yeah. And I think our industry does a great job of talking about annualized returns historically, and we share this all the time with clients, but it never looks under the hood and shows you how lumpy those monthly returns are to make up that year.
Absolutely.
Yeah. So let's continue this conversation then into December, because December is historically a very strong month as well in the market.
That's right. Yeah. So we've talked about the seasonality of returns over the past 3 or 4 months, I believe now. This is a different chart of it. This shows the average return per month for the past 75 years or so, and the probability, the percent of years that these months have been higher. So what you see here is there's a 74% under that dark blue arrow. That says is December since 1950 has been positive 74% of the time. It has the highest percent positive ranking amongst all months. Second is April. So we are optimistic. Its return, however, is just ahead of middle of the pack. So the seasonality we think will continue and certainly continue into next year, but let's focus on December. There should be more positive to come. December's a unique month, right, Julina?
Yeah, it is. And I think we know how granular you love to get, Bob. So talk a little bit about some of the nuances of December.
Yeah, so you have a first half, second half, and I know that sounds like we should be talking about years. Let's talk about December. The first half of December is historically either flat or slightly negative. The second half is positive. It's either positive or more positive historically. And part of that, Julina, we talked about September 30th being the fiscal year end for many institutions and endowments and asset managers. They close their books, so they do a lot of tax loss selling. They try to realize some gains, take some profits before the end of the fiscal year.
Yeah.
You then have some other institutions, fewer of them. I would say probably about 25% of the same institutions in the same industries. They have a fiscal year end that is December, end of the year. So they're doing the same stuff, right? The first half of December, they're rebalancing portfolios, they're taking tax losses, they're taking some gains. Really, what it is mostly money in motion, and it's mostly selling. And that creates a little bit of a speed bump for the month. They're usually done by mid-December, and that is typically why you see late December turn positive. We think that should be the case, just going off of history this year.
Okay. Well, I joked with you earlier that this was not just because there are a lot of individuals like myself that have not yet gone shopping.
That's right. It has nothing to do with the shopping.
Okay.
I mean, don't get me wrong. If you do shop and it's broadcasted that you spent a lot of money, then that's good for the consumer, apparently. Right. But that's also good for marketing purposes when you hear it on CNBC saying, hey, the consumer's spending a lot of money. Yeah. Things must be good.
Well, and as I joke about this, it is important to see, that, we did have record sales on Black Friday this year.
Absolutely. So yeah, fun chart here. So you hear a lot about the consumer is stretched. They're starting to use their credit cards. Interest rates are very high. But boy, oh boy, Black Friday spending, this is online spending, set a new record, just shy of $10 billion in online sales for Black Friday.
One day.
We're at a new all-time high.
Yeah.
It's amazing. So I guess the consumer is stronger than most think, and they're willing to spend money, mostly because they have money or have access to money. That is a good thing for the economy.
Yeah. And I know we're going to question this recession conversation in a moment, but this is another slide that questions whether or not we are, in fact, in a recession.
Yeah, I feel like I was a big contributor to that $9.8 billion.
And you're making me feel guilty that I wasn't, but that's okay.
Let's get going, Julina. Get moving.
So this is a really important one, right? Dividends and buybacks. If you can maybe talk about what are the implications when you hear the media and economists talk about the fact that dividends and buybacks are rising.
Yeah. So if you think about, we talk about stocks and bonds, right? What are stocks? They represent units, percentage ownership in a publicly traded company, whether it's an S corp or an LLC or a limited partnership, right? You own, you're a shareholder in a business, and publicly traded companies are either making a profit, looking to make a profit, or will be making a profit in the future. And if they don't, over a long period of time, they won't exist, right? So ultimately, if companies are profitable, they and they're publicly traded, they have shareholders, they like to reward their shareholders, right?
Yeah.
Sometimes they pay dividends, sometimes they don't. You have a company like Amazon that doesn't. They, in essence, take all their profit and invest it back in the business, but their shareholders are okay with that because they have shown a tremendous amount of growth using their own cash rather than sending it to investors. But many companies, many mature companies, pay dividends. And here is the wall of dividend increases. It just keeps increasing over time. And this is a very healthy chart. It tells you what you can deduce from this is companies pay dividends if they have cash. If they have cash, they must be profitable. If they're profitable, they must be doing something good. And it comes full circle, they pay more dividends, right? So when you go back, I don't know, to 1999 on this chart or 2000, the S&P 500, the companies in the S&P 500 were paying out about $30 billion a quarter in dividends.
Which, by the way, at the time, the comment was how powerful that was.
It was and is.
Yes.
Today, the S&P 500 companies
Mhm.
in aggregate are paying out approximately $150 billion a quarter in dividends per quarter. Used to be about 30 billion a quarter. Now it's 150 billion a quarter.
Grown 5 times.
Unbelievable. So a 500% increase, a 5-time increase in dividends. Dividends are very powerful for shareholders. I think ultimately one of the filters that we have with our investments behind the scenes, I don't want to share all of our secrets here, we're always screening for the dividend play, whether they be dividend payers, more specifically dividend growers that have grown their dividends consistently over time. It is incredibly powerful, and it is something that we're always looking for because there's a very close correlation to those companies being high quality. Another thing that we look for, and those companies usually outperforming over a long period of time. Anything can happen in a short period of time, but over a long period of time.
Exactly. Yeah. Thank you for sharing that. And we have another slide that talks about buybacks more specifically. And we get this question all the time, Bob. Why, when companies are buying back their own shares, what are the implications to the shareholders? Why is this important?
Yeah, and we talk about this behind the scenes all the time, right, Julina? So positive shareholder activity through the lens of a corporation or an investor could be, I can reward the shareholders with more dividends, right? Never mind being more profitable. That's a given. That's goal number one. Number two, it is to reward the shareholder with more dividends.
Mhm.
There's another option. The other option is to buy back their own shares. So a company, when they have excess cash, they'll increase the dividend payout. They may start paying a dividend if they haven't paid a dividend. What they can also do is they can use some of their cash to buy their own company,
Mhm.
buy their shares back. What happens in that case? Well, remember, a company doesn't have an unlimited amount of shares. They have a fixed amount of shares that they've gone public with. And you, as an investor, you may own some of them. But there aren't an unlimited number of shares, which is why share prices go up and down, right? When a company buys back its own shares, it reduces the amount of outstanding shares, which by virtue of that makes your shares more valuable. There's a
Yeah.
scarcity value to it all, right? There's fewer of them. It's a wonderful thing for shareholders. It's a wonderful thing for returns. And not to get too granular, over time, when the stock price of a company gets a little too cheap,
Mhm.
a company will come in, the company that is too cheap will come in and buy some of their shares at a discount. What a great investment, right?
Right.
And
Exactly.
who knows better about the company than the company?
Yeah, is it also fair to say that the perception to the market is that the company itself believes in its own company going forward?
Absolutely.
Okay.
Absolutely. Yeah, you want to avoid companies that are doing secondary offerings, in essence, diluting you as a shareholder, all of a sudden creating twice as many shares. Your shares become less valuable immediately. You want to shy away from companies where all the executives, all the higher ups who have to disclose their trades are dumping shares of their own company
Right.
all the time. I understand they need to liquidate for tax reasons and for other reasons. But if we see insiders of these companies getting rid of all their shares, that's something we pay close attention to.
No, that's great. And we just talked about the strength of Black Friday this year and the opportunity going forward with dividends and buybacks. But we did also want to share a really interesting slide that talks about our economy, which you can see on the far left, that V-shaped is the pandemic and how quickly not only did we fall into a recession, but how quickly we recovered. But I think what's really interesting, if you can address this, Bob, is where are we since then? Because when I look at that line going higher, it doesn't feel like we're in a recession.
Agreed, because we're not. Uh,
Okay.
what you can argue, though, and we've been talking about this, Julina, for months, is in the middle of the page where the Q4 21 dot is and
Mhm.
how it declined into Q2 22.
Yeah.
You and I and everyone at this firm are adamant that that was a recession. It wasn't called. That
Correct.
had all the flavors of a recession except for rising unemployment. But that certainly looked and felt like a recession. Almost all the data was flashing that way.
Mhm.
But ultimately, it hasn't been called. It still might be called looking backwards now in the future. But you hear all this talk about a recession, a recession, a recession, a recession. Maybe I'm wrong, Julina, but isn't there just generally speaking growth of the economy on this chart?
Exactly. Yeah.
Yeah. So you see that big V is when the world shut down. So keep in mind the global economy, never mind the US economy, the global economy shut down. That is that big V down in Q2 of 2020. That was a recession. It was sharp, but it was brief. It was the shortest recession ever in history. We bounced back immediately. Now, part of that is, of course, the numbers look this way because we went from zero to something.
Yeah.
So the economy was closed, then it wasn't. And when it reopened, the data just showed now we have economic activity after not having any.
Exactly.
So that's why that spike looks so sharp. But since then, the angle has been up, and we think it's going to continue to be up. Maybe not as sharp, but
Hmm.
we think it will be up. It's going to flatten out a little bit, but it should still have an upward arc. So the strange label here, the strongest recession ever continues. I don't know, Julina. I want to think of recessions as a bad thing
Yeah.
that clearly show negative things. I think it's hilarious that people are still using recession, recession, recession when the economy is showing anything but that data.
Yeah. And
So,
we joked earlier in one of our previous webinars as to how often the word recession was Googled this year. And
yeah,
so we have to continue to address it. And if we are in one or we're in one, this is just another indication that not all recessions are equal.
yeah,
So thank you. And also talking about previous webinars, we have spent so many months talking about the bond market and the opportunity in the bond market going forward. And maybe we can address the fact that we're finally starting to see signs of opportunity, because when you look at November not only being great for the stock market, it was also one of the best returns for the bond market.
yeah. Measured in aggregate, right? It when we look at the entire bond market, that's what this chart is measuring. So the inverse relationship between yields and bond prices. And this is why, for I think a lot of investors, bonds are difficult to grasp, especially in times where interest rates are moving in a very volatile manner, up and down. So what you see here very similar to the stock chart, the November chart that we led off with, this is the return in the bond market and the variability of returns. Just zooming out, you see that sort of the middle of this chart from maybe 1986 to 2021, returns, you could draw lines at the top and bottom. We just have one at the top.
Mhm.
We're in this pretty tight range. And most of that is driven by interest rates generally were either slowly coming down off of high levels or dramatically coming down, but off of low levels.
Yes.
So the return band of bonds was just so stuck in this tight range, which was a good thing. You start to see on the left edge and the right edge, the returns start to go way up and way down
Yes.
by a pretty huge spread. Well, yeah, that's what happens when interest rates go from zero quickly to 5.25%.
Yeah.
It sends the bond market into a tizzy, and it becomes hypersensitive now to small changes in rates. And what we've seen over the past, let's call it 6 months, is maybe the summer we had rates at a relatively low level. I believe the bond market was pricing in a Fed that was done,
Yeah.
and the next step would be cutting, which I think is absolutely the right thing to price in. But the long term part of the bond market was skewed temporarily this summer by Janet Yellen raising a lot of money in the bond market, sending long term bond rates up dramatically and
Yeah.
prices down. You then, that all stopped at the end of October when she announced that she was, generally speaking, saying she was done raising money for the government. She raised enough quickly.
Hmm.
That sent rates back down to a much lower level. So just to actually give you the data, the 10-year Treasury peaked at about 5% mid to late October. It is now about 4.2%. And I know that doesn't sound like much. That is a dramatic move in interest rates, long-term interest rates. This isn't Fed controlled. This is market controlled. These are very different things. And the move down in interest rates from 5 to about 4.2 sent the bond market up in a month
Hmm.
by 4.5%.
Right.
Now, keeping in mind, this bond index we don't own, we think it's a little too volatile. It went from deeply negative to just about slightly positive in 1 month.
Yeah,
In 1 month.
exactly.
Yeah.
Yeah, and this is a taxable index. We saw the same thing in the municipal bond market as well.
Yeah, not as much because it's a different yield curve, but yeah, a similar reaction as
But
well.
a similar record month.
Exactly. Bonds are tough. They're hard to understand. Thankfully, we understand them quite well. We have a lot of experience in fixed income. We believe we position client portfolios properly. We know where the places are to avoid, and we like to think we know where the places are to invest. So we're very confident in how we are positioned for the bond market.
Yeah, and I think it's hard not to look at the left-hand side of this page and look at those returns before 1985, right? And for many of the listeners, you probably recall the 80s and the peak in interest rates and then the decline from there. And that's just again bond math, just showing the returns that came from declining rates back then. And then the other thing I would suggest is that, to have the best month since 1985, right? I was joking with you earlier. I wasn't going to ask you how old you were in 1985, but instead, I will reference maybe if you are a fan of music, that was the year of Bruce Springsteen, Born in the USA.
Sure.
If you are an athletic fan, that was the year that Michael Jordan was named Rookie of the Year. Or if you're a movie fan, that was the year of Back to the Future. So that was a long time ago. And
Long
so
time
I
ago.
think, again, we've been very patiently discussing the bond market and the implications of potential return going forward. So hopefully this is the beginning phase of that.
Yeah, and I guess the same comment I made about the market, the stock market in November, it's returns come in bunches. If you missed out on the bond market return in November, you technically, as of today, would have missed out on 100% of the return in the bond market. So
Absolutely.
the positive return that the bond market might end up with this year was solely made in the month of November.
That's a
Period.
great point. So thank
That
you
is
for
a
saying that.
fact. And if anyone has questions about that, I'm happy to show it to you.
Thank you. And we have to talk about government spending. This is not a new topic. However, given what has transpired, what this chart is showing is the growth of government debt just in the last 6 months. This is something we believe we're going to be talking about going forward.
It's an important topic, and it's going to be talked about on the campaign trail. It is going to be talked about in the financial media, and ultimately, it is now a big deal. The big deal is the level of debt, number one. What's more important is the interest rate now of that debt, where it was, where it is, and where it's going. It was low, it has gone higher, and it's going to go higher. And what that actually means, it means that the expense of the debt, interest on the debt, the interest expense is quickly becoming the largest single expense of the United States government, which far exceeds all of the government's discretionary spending, all categories, discretionary spending. The interest expense is larger than all discretionary spending. And that just happened.
The
And
interest expense.
just the interest. So in essence, the interest on your credit card debt is bigger than all of your discretionary expenses personally. Now, bring it into government form, the interest on government debt far exceeds all discretionary spending at the government level. We also think that the interest expense will exceed Social Security, Medicare, Medicaid, which are currently number one and number two when it comes to government outlays. We think within 3 years, interest will be larger as a category than anything else. It will exceed Social Security, Medicare, Medicaid. And so that is new, and that is scary. And I think this is going to lead to massive fiscal changes. I think because it has to. And you are going to hear about this a lot going forward. This will probably lead to lower interest rates, one. Number two, this will lead to some type of entitlement reform, probably impacting people that are younger than 50 years old, with changes being phased in over, long periods of time, and probably some type of Medicare, Medicaid modification. We don't know how they're going to do it. We don't know what they're going to be able to do. What we do know is it is going to take a second term of a president for a lot of these changes to happen, because if you do it during your first term, you won't have a second term, and it will be unpopular for a moment. But ultimately there are some real changes that have to happen, and spending needs to be reined in. I wouldn't even say by a little, but a lot. Increasing taxes, I'd love to say it makes a big deal when it comes to this. It doesn't.
Okay.
We
Yeah.
are not going to tackle this issue with tax increases. We won't even come close. We need to tackle this issue with spending control and really some financial due diligence around who is spending money, how much they're spending it on, what they're spending it on,
Yeah.
and making sure it is done properly.
Yeah, and I think it may also be important to note that the slide here is showing the total amount of debt, right, which is that 33 trillion. The other way that the markets talk about this that you may hear going forward is the debt as it relates to our GDP, our economy. That level, basically what they're trying to tell us is that our debt is growing faster than our economy. And that's another concern.
100%. And it is set to grow faster than our economy because you have two valves. You have the amount of money that's being spent,
Mhm.
you have it compounding with a new higher interest rate.
Correct.
It's not just the pure expense, it is also interest compounding.
Right.
So there are two
Debt has
simple.
grown so high.
Exactly. Yeah. And I
Yeah.
mean, even as of this chart is stale. It's, I don't know, 10 days old. Yeah, it's a week and a half old.
Right.
We now have $34 trillion of debt. So you could see if even if we stop spending money for a little while, it will just tick higher
It
because
just ticks
interest
higher.
compounds.
Yeah.
Yeah, the interest on $34 trillion of debt is $1 trillion. That's per year.
Correct.
Yeah.
And I think one other way to look at this topic that's important kind of going into next year is the fact that a third of our government debt outstanding is actually due to mature over the next year. And that's about, over 7 trillion.
Mhm. Yeah. So what you're seeing here, Julina, is there's about $8 trillion of debt maturing. And to clarify that, that means there's about $8 trillion of U.S. government treasuries maturing over the next year. And that money will very likely roll back into the treasury market. I'm sure that the Federal Reserve looks at this, and I feel that this is one of the items that the Fed might be using to help them make a decision on where interest rates should be next year. And seeing that they work for the US government, I think this will help them bring rates down by a little bit more than the market is pricing in
Mm-hmm.
and a little bit sooner than the Fed is talking about. Because if they don't, it is going to cost the government a fortune. Because remember, a lot of that debt that was issued, if you really stare at this chart, popped up around pandemic time, right? That was issued at literally 0 to 2% rates. And if nothing changes, it will be reinvested at 4 to 5% rates. So the cost of that 8 trillion that is about to mature is going to increase by 4 times.
Yeah.
So that will be very costly if that happens.
Yes.
So I feel strongly that this is one of the items that the Fed is probably looking at that's in the camp of bringing rates down a little bit and doing it sooner to sort of ease the pressure going forward.
Okay. That's
So
great.
you won't hear anybody talk about this one. And I don't even think they'll admit it, but I feel very strongly that this is something that the Fed is looking at, if not talking to the Treasury about how they can assist with the $8 trillion rollover in treasuries over the next 12 months. That's massive. That's 31% of US government debt.
Exactly. And clearly something that we're going to keep our eye on and we will continue to monitor and talk about in the new year.
Absolutely.
Yeah.
I should mention, I don't want to get too granular, just the $8 trillion maturing and going into the bond market
Mm-hmm.
is going to move rates down alone.
Okay.
That will be the market, the
Yeah.
inflow of money, the demand for treasuries is going to move yields down by itself. We think the Fed will bring the short end overnight rates down a little bit, probably even more than they're talking about next year. You even now have a lot of people on TV talking about the Fed potentially cutting rates in the first quarter. In January, Julina, we thought the Fed would be cutting by December, and we got laughed at. We're not too far off. And December's not over yet. There's one more Fed meeting.
Exactly. And as much as bonds can be confusing and seem complicated, it really does come back to bond basics and bond math.
Mhm.
And rates down, it's the seesaw, it's bond prices going higher. So,
Absolutely.
and thank you for going through that. As always, we are trying to share our reasons for optimism in the market, and always with an insightful eye on where there are areas of concern and what we should be, keeping an eye on going forward, if that's fair.
It's fair.
And I didn't want to end the year without maybe addressing the loss of an icon in the industry just recently with the passing of Charlie Munger at the age of 99. He was Warren Buffett's business partner. He was vice chair of Berkshire Hathaway. And he was very well known for his comments and his insights on the market. And so one of the ones I thought I would share is his quote is, "The big money is not in the buying or selling, but in the waiting." And so I think it's just very appropriate for this environment. We are very thankful that we have clients that have been patient with us through this environment, and we thank you for that. We thank you for your trust. And as always, if you have any questions, you can reach out to any of us here at the firm. And we hope that you have a fantastic holiday season.
Well said. Agreed. And happy holidays to everybody.
Thanks, Bob.